Alternative investments refer to assets outside traditional asset classes like stocks, bonds, and cash. These include real estate, private equity, hedge funds, and commodities. The purpose of alternative investments is to enhance diversification, reduce risk, and improve overall returns. Alternative investment classes include real estate, private equity, hedge funds, commodities, and collectibles. Real estate involves investing in property. Private equity focuses on private companies. Hedge funds use various strategies to generate returns. Commodities include physical goods, and collectibles encompass items like art and antiques. Real estate investments can be categorized into residential, commercial, industrial, and land. Benefits include rental income, capital appreciation, and portfolio diversification. However, risks such as market risk, liquidity risk, and management risk need to be considered. To evaluate a real estate investment, estimate the rental income and expenses, calculate the net operating income, NOI, determine the capitalization rate, cap rate, and assess the property's value based on the cap rate. This example demonstrates how to evaluate the potential return on a rental property investment. Private equity investments include venture capital, buyouts, growth equity, and distressed investments. Benefits include potential for high returns, active management, and long-term growth. However, risks such as illiquidity, high fees, and management risk must be considered. To evaluate a private equity investment, estimate the startup's future cash flows, apply a discount rate to determine the present value, and calculate the internal rate of return, IRR. This example demonstrates how to assess the potential return on a private equity investment in a startup. Hedge fund investments employ various strategies, such as long-short equity, market-neutral, event-driven, and global macro. Benefits include potential for high returns, diversification, and risk management. However, risks such as high fees, leverage risk, and lack of transparency must be considered. To evaluate a hedge fund strategy, calculate the fund's returns, compare them to a benchmark, and analyze the risk-adjusted performance using metrics like the Sharpe ratio. This example demonstrates how to assess the performance of a long-short equity hedge fund strategy. ESG considerations involve evaluating the sustainability and ethical impact of investments based on environmental, social, and governance criteria. With increasing demand for responsible investing and long-term sustainability, it's important to integrate ESG factors into investment analysis and decision-making processes. To incorporate ESG considerations in a real estate investment, assess the property's environmental impact, consider social factors such as community benefits, and evaluate governance practices related to the property. This example demonstrates how to calculate an overall ESG score for a real estate investment. Alternative investments include real estate, private equity, hedge funds, and more. Evaluating these investments involves assessing potential returns, risks, and benefits for each asset class. ESG considerations are increasingly important for sustainable and ethical investment decisions. Practical implementation involves using tools and techniques to evaluate and integrate ESG factors in alternative investments.